The Bretton Woods Agreement of 1944 established fixed exchange rates defined in terms of gold and the US dollars. Between 1944 and 1971, many currencies were pegged against the US dollars. Their parities with the US dollar were fixed. In this period, a US dollar was promissory note issued by the United States Treasury. If anybody requested, the Treasury had to exchange the note for 1 per 35th of an ounce of gold. Under this system, overvalued or undervalued currencies could only be adjusted with the agreement of the International Monetary Fund. Such adjustments are called devaluation and revaluation. The Bretton Woods system of gold convertibility and pegging against the dollar was abounded in 1971. Because the following inflation, the Federal Reserve did not have enough gold to guarantee the American currency. B. Gold convertibility was replaced by a system of floating exchange rates. Today, the US dollar, the unofficial world currency, is merely a piece of paper on which is written in God we trust, God not gold. A freely or clean floating exchange rate is determined purely by supply and demand. Theoretically, in the absence of speculation, exchange rates should reflect purchasing power parity, the cost of a given selection of goods and services in different countries. Proponents of floating exchange rates, such as Milton Friedman, argued that currencies would automatically establish stable exchange rates which would reflect economic realities more precisely than calculation by central bank officials. Yet, they underestimate the impact of speculation and the fact that companies and investors frequently follow short-term money market trends even if these are contrary to their own long-term interests. C. In the late 1970 and early 1980, the American, British, and other governments deregulated the financial system and abolished all exchange control. Reason is that these countries are now able to exchange any amount of their currency for any other convertible currency. This, had, this has led to the currency situation in which 95% of the world's currency transactions are unrelated to transactions in goods but are purely speculative. Enormous amounts of money move around the world, chasing high interest rates or capital gains. As investors, including rich individuals, companies, and pension funds, seek to maximize the value of their assets. In London alone, in the late 1990, over 300 billion worth of currency was traded on every day, the equivalent of about 30% of the value of goods Britain produced each year. Banks, of course, make a profit from the spread between a currency's buying and selling price. D. Few government, however, leave exchange rates wholly at the mercy of market forces. Most of them attempt to influence the level of their currency when necessary. managed or dirty. Floating exchange rates are more common than freely floating ones. For example, in the 98, most Western European governments joined the EMS, European Monetary System, which established parities between member currencies. There was also an exchange rate mechanism. If the rate differs by more than plus or minus to 1 per 4% from the central parity, central banks had to intervene in exchange market, buying or selling in order increase or decrease the value of the currency. Yet international speculators can be more powerful than government. For example, on a single day in September 1992, the Bank of England lost £5 billion in a hopeless attempt to support the pound sterling. For weeks, all the world financial institutions and rich individuals had been selling their pounds, as everyone except British government believed that the pound had been seriously overvalued ever since it Billet joined the ERM in 1990, when the British Central Bank ran out of reserve and could no longer buy pounds. The currency was withdrawn from the ERM and allowed to float, instantly losing about losing about 50 of its value against the demand. The next year, speculators attacked five other European currencies and the European monetary system was suspended. It was later reintroduced in a looser form. Many manufacturers are in favor of fixed exchange rates or a single currency, although it is possible to some extent to hedge against currency fluctuation by way of future contracts. Forward planning is difficult when the price of raw materials bought from abroad or the price of product in beginning in 1999. The new currency was used as a means of payment between companies and in foreign trade, and bonds were denominated in it. The euro came into existence as a real currency in 2002 when the old notes and coins in the 12 member countries were withdrawn.